Welcome to This Week in Money. I'm Jim Goddard. Today, Martin Armstrong of Armstrong Economics on how safe your money isn't in the bank and the secret about inflation the government certainly doesn't want you to know about. And CIBC Wood Gundy's Ross Clark charts the action of the Canadian dollar, the Standard & Poor's Index, and gold right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is Martin Armstrong, founder of Armstrong Economics. Welcome to This Week in Money, Martin.
Oh, thank you for inviting me.
One of the things you've been writing about lately is the threat of bank bail-ins. The public calls them bailouts, but we call them in the industry bail-ins. Maybe explain your concern and what could happen to somebody's bank account.
Well, amazingly, what's happening is that since the last bailout, where for example, the U.S. government had to write a check for $700 billion, there's been such a kickback from the political side against politicians bailing out the banks. And so what's happening is that they've kind of come to the conclusion they can't do that again. So unfortunately, we have really the IMF, which is about the closest thing to a Marxist organization I think you can possibly come. And everything they look at is that we, as civil, the society, that the people, that we're just really here for their amusement, I think. And so they've actually put out written papers and saying that the cost of bailing out the banks really should be borne by the people who have deposits there. And they're saying, and as they did in Cyprus, they just basically down there, they took almost 50% of everybody's money. And right now for Europe, they're saying, well, the way to bail out the banks is basically just take 10% of everybody's funds. And so the way they look at it is that more or less that it's our fault, although we have no control over how the bank is run or who they have invested money in or what they've done with it in any context. Yet we're responsible for those decisions that go wrong. And, the whole problem has been that the banks in the U.S. Were led by Rubin, who was former chairman of Goldman Sachs. And he went in there to become, Secretary of the Treasury with an agenda, and that was to open up the door and allow the banks to do whatever they wanted to do. And so he rescinded the Glass-Steagall Act, and he moved largely for that. And then he also moved through the WTO, the World Trade Organization, to allow banks to be able to sell derivative products as an export to other banks. And those two maneuvers have basically wiped out an awful lot. And then what happens is you create an incentive for the banks that, hey, why should I lend you money and I have a risk that you're going to pay me back when I can just trade, the Canadian dollar, the euro, or whatever, and I make money on a daily basis. So, it changed the function of a bank, honestly, and then they started making more money from proprietary trading than they did as a bank.
Maybe explain what Glass-Steagall was and why it was put in the first place.
Well, Glass-Steagall was put in the Great Depression, and it was largely because there was too much coordination between selling trust funds, and there was a brokerage, and the banks were basically one. So the problem was that in selling a lot of this paper and raising money, what they were doing was really undermining themselves. And in 1931, we had massive defaults, which most of the history books have omitted, including Galbraith's famous book, The Great Crash. There's no mention that really what made the Great Depression so bad was that it was a sovereign debt crisis. All of Europe defaulted on its bonds permanently. Britain went into a moratorium. France was so-so, holding on back and forth. China defaulted. South America defaulted for about the fourth time. So what had happened was that back then they issued these bonds in small denominations. So it wasn't like a national debt that governments held. They sold them in small denominations, and then the banks sold them to the individuals. So that's why there was this huge collapse. Because once at least the stock market declines, and it only declined about 60% up until 1931. Then it started to rally. When 1931 comes, that's it. I mean, it falls to like 10 cents on the dollar because you wiped out capital formation. And the famous saying, really, of when the stock market first started crashing in 1929 was that gentlemen buy bonds. I mean, Marilyn Monroe turned it into blondes, but the original was bonds. And it was an arrogance of saying, see, I'm conservative, I don't mess with stocks, I have bonds. Well, then, the difference between bonds and stocks is that stocks, at least you get something back. Bonds, if it's a government, you get nothing back. So that's really the problem. Even the city of Detroit temporarily defaulted in 1937, as they're doing again today. Yes, they finally made good. When? 1963. So if that was your money for retirement, I guess you basically starved to death.
So what kind of products do you think the government would go for if they decided to do a bank bail-in?
Largely, Canada, Switzerland, I mean, they're all on board with this. And instead of bailing out the banks with taxpayers' money, they're just simply going to take a slice right off the top of everybody's accounts. And this, in part, is with some big money, what's causing it how are people dealing with it? You have real estate boom in London going absolutely crazy. And I was just over there a few weeks ago. I mean, you never saw so many Ferraris, Rolls Royces, Bentleys in one area. It was just unbelievable. I mean, maybe you'll see 2 or 3 in New York. Over there, it was 2 or 3 on a block. I mean, everybody was there. All the Arabs are there. The French have abandoned Paris, and they moved over to London. And it's just a boom. I mean, everybody's just trying to get money off what I call the grid, getting it out of banks, putting it into equity, putting it into real estate, which they feel largely would be at least safer because if when the banks go, they're not going to be able to grab those assets. So that's why I think the stock market still is, I mean, although we have a near-term correction coming, longer term, the stock market is not overvalued. It is going to rise probably at least another 50%, maybe more.
So you're not one of those people who believes an imminent collapse is going to happen, or if there is a correction, it's going to correct the other way very quickly.
Look, I mean, those people that, I don't know, we call them basically the talking heads, they don't really even think about what they're saying. All right, if the stock market's going to crash as in 1929, then it's always a yin and a yang, okay? You're going to sell the stocks, now we're going to put the money. Oh, you go to government bonds? Well, but government bonds are what we have, which is in crisis. Not only like cities like Detroit and provinces like up there in Ontario. I mean, Europe is an absolute disaster zone, and there's no hope here for government because they just look at us as an endless cash cow. I mean, like Ontario. I mean, there's no concept of that perhaps, the cost of government is too high. In Germany, more than 50, and the average German has to work more than 50% of the year just to pay taxes. And, we call them public servants. Why? Because it is like you went out and you hired a maid to take care of your house. She doesn't bring home any income. She costs you. So, let's go ahead, hire 2 of them. As long as you got the income to pay, because they're not going to increase your income at all, that's fine. But at some point in time, what's happening here is then they promise themselves all sorts of pensions. And they're always more lucrative than what we can get in the private sector. And City of Detroit went down. Why? Because effectively what you ended up with was more than 50% of the tax revenue was going to pay pensions. Now, if you just looked at this on a practical level, take a town. Let's say it's got 20 policemen. 10 retire. Well, now you got to give them pensions. But now, to keep the same level of services, you have to hire 10 more. So the cost of government is actually rising exponentially faster than anything in history. This is why our taxes are going up. And then they're out there picketing, saying, hey, protect our pensions, make the bankers pay, or whatever. Somebody has to pay for this. And unfortunately, it's always the taxpayer. Now, government likes to, to divert attention from itself and saying, oh, the rich aren't paying their fair share. Okay, that's very nice. But if you took all the assets from the so-called rich, you don't even balance the budget for a year.
And who's going to create jobs with new factories or just keeping factories open?
Zero. That's the whole problem with Europe. The unemployment among the youth is over 60%. I mean, you ask the average German, are they interested in starting a company? Answer is no. The bureaucracy is just huge. And the taxes to start something are really just off the charts. I mean, when I started my company, I could do it with $600 years ago. Good luck today. I mean, you have to have all kinds of insurance that, they passed a law over here to say we had to have some sort of liability insurance in case somebody tripped or fall. We're not a store, an office. Anybody, I sat down and figured it out. Anybody that would come to see us is working for a company. So therefore, they were already under workman's comp and could not sue under such a policy.
Well, I always wondered, the city of Vancouver is moving their property tax burden from commercial property to the individual's property, saying, well, the individual uses government services more than industry does. But when you own a home, the only time you make money on it is when you sell it. When you just live in it, you're not making money with it, you're spending money. Where are you going to find this extra 8 or 9% a year that they're demanding?
Yeah, it's property taxes are probably the worst, because what happens is that you work your whole life, now you want to retire. Taxes keep going. There's no way to say, all right, just stop the merry-go-round. It just keeps going and going and going. And then you had here in New Jersey so many people moving to Florida. So then they didn't like that. So what did they do? They put in an exit tax. So it's kind of like going to a nightclub. Okay, fine, you pay a fee to get in. Now you got to pay a fee to get out.
Well, that's kind of like East Germany. They would shoot you if you tried to get out. Are they going to put barbed wire up along the New Jersey border?
Who knows? I mean, California is a disaster zone. And people that worked in California retired and moved to Florida. They started chasing them in Florida and saying, well, your pension you earned while you were in California. I want to tax them out there. It's nobody is sitting back and saying, hey, we have to revise this model. Government cost is going up exponentially. If we look at the national debt, all this propaganda and socialism that they talk about, oh, the poor, 70% of the national debt is back interest. It didn't help anybody, didn't create a single road or schools or anything. All right, just add it up. It's 70% on average. That's for Germany, United States. It's almost 70% of the entire outstanding national debt is a cumulative interest. And then it's basically they never pay anything off. They just borrow more money year after year after year, so the interest is consuming everything. And eventually, I mean, a 2-year-old with a pocket calculator can figure this out. Politicians can't, but there's no possible way this system is going to continue forever. It's got to go bust. You know, all right, we're at 70%, and everybody's beginning to realize something's wrong. The taxes are going up and up and up, and our standard of living is going down. And so, at what point does the bubble completely burst? 75%? 80%? We know at 100% we're completely dead. So how much more can we endure? I think we got about 2 years left, and then we're going to start seeing things really start to rocking and roll. And because the system is completely, it's just, honestly, nobody would have sat down and designed such a thing.
More with Martin Armstrong next on This Week in Money.
Always consult your investment professional before making any investment decision. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. We're speaking to Martin Armstrong of Armstrong Economics. Martin, you're very concerned about the large debts that governments are carrying. The Canadian government claims it's going to give us a balanced budget next year. Coincidentally, just in time, it'll arrive just before the next federal election. Is this going to stop the government from doing unpopular things like a bail-in to a bank? No,
not really. You look at Merkel, she basically lied about everything just to get elected, and right after the elections, shot down any possibility of referendums or anything like that. And then she handed all authority to review the banks to the EU. So they will lie and say anything they have to just to get past the next election. And that's the problem we have. We do not have, they like to say we live in a democracy. We do not. We live in republics. And there's a substantial difference. A democracy, you vote on everything. Should the taxes go up? Yes or no. Should you do this? Yes or no. Should there be war? Yes or no. Okay, that's a democracy. A republic, we vote for one guy, he goes down and says, well, this is what we're going to do. You have no clue what he's going to say, and he doesn't represent you as an individual. And, you know, people don't appreciate this substantial difference. Because once they are there, then they become career politicians. And a career politician, then his self-interest is to maintain government, not you. And he'll say whatever he has to say to basically just win the next election. And, I mean, I have worked with politicians around the world, and it's always the same thing. There is no long-term planning at all because of this system. And when they have to go for re-election all the time, all they care about is what do I have to do to win the next one. It's not, well, gee, if we fix this, we don't have a problem 25 years from now. I'm not even going to be here. Don't worry about it.
Here in BC, there is a small political movement that says right in the Constitution that voters have the say in the running of the government. And yet, like you said, for 4 or 5 years, we don't have any say. The politicians run it. Why not? With modern technology now, with our smartphones and computers, we could vote on any major issue, a budget. Should we build a new park in this part of the city? The ability to reach 90% of the population, and usually only 40, 50% vote if you're lucky. We have the technology for every week. Here are the issues facing your city council. How do you think they should vote? you could have direct democracy doing that.
Absolutely.
I know the politicians always say it would be too costly, but look at the cost of the projects they do now, and they turn out to be white elephants.
Oh, it's a complete disaster. I mean, we don't need career politicians. Once we have them in there, then they line their pockets. I mean, Obama's numbers are out. When he took the presidency, he was worth $1.3 million. He's now worth $12 million. Okay, how does that happen? You know, they've suddenly become miraculous investors, and it's just the way it is. They vote according to whoever tells them what to do and who has the biggest check.
How did Obama get so much money? I thought the president was paid something like $250,000 a year.
No, he's paid about $400,000. That's it.
$400,000. Oh, he got a pay raise. How nice.
Yeah, in 2001. So it's only comes from supposedly investment. All right. So they talk about. I mean, it's a classic example. He stands up and says, "Oh, you know, we have, you know, the rich, they don't pay their fair share." All right. If you earn $100,000 a year, you're in the top 1%. He is there. Okay. So it's just propaganda, and it's really ridiculous. But as long as they can say, "Oh, it's the rich and they haven't paid," all right, then you're not going to look at them. That's what it's all about. It's a shell game. And I don't care. All right, fine. You take all the money from Warren Buffett, you know, $8 billion. Okay? Does that pay? We have a budget deficit, a budget for the year of $1 trillion. Take him. Take Bill Gates. Take all the top billionaires. You haven't even touched anything yet. So it's a great propaganda thing, and everybody thinks, oh yeah, we wouldn't have a problem if they paid. I'm sorry, take everything they have. We have more of a problem, because that's not the issue. The issue is basically the cost of government, and people are not looking at this.
What do you think is going to happen to Canadian real estate? We've had international experts tell us that it's overvalued anywhere from 20, 40, sometimes 60% more than what we should pay for it. Is there an answer to that? Are we paying too much, and is it worth a lot less?
It's a function of two things. One is leverage from effectively being able to borrow. In the United States, we have the 30-year mortgage. Who created that? That was FDR. Why did he create it? Because property values that you had farmland that was worth like $2.50 an acre fell to 5-10 cents in auctions. All right, and you couldn't sell anything unless somebody had cash. So he created the 30-year mortgage and made it 30 years to give you as much leverage as possible to be able to pay this stuff. So unfortunately, the price of a house from that perspective alone is not what you could afford. It's what you can afford over a 30-year period. So the price of the house rises because now you have 30 years worth of potential income to pay for it.
Here in Canada, the government just took away the 30 and 35-year mortgages. It's now 25 years again. Was that a good move?
Well, it's from a borrower's perspective, maybe you want to lock in as much as you can because you're basically giving somebody else the risk. Interest rates will rise. There's no choice about that. They can keep them suppressed as much as they want, but that's very nice. But, interest rates will rise. The other side of this with the property is what I said. So many people are trying to get off the grid. You have a lot of money coming in from China. China tends to be like the Japanese were initially. They want to buy the trophy places. So the high-ticket places, that's what China's buying. Actually, Canadians, the biggest buyers in the United States for the quantity of properties are Canadians. And if those that are looking to buy property in the United States, I would look in Florida or in Texas. They have the two best laws. Even O.J. Simpson, when he was found innocent, but then the families were going to sue him. The first thing he did was buy a house in Florida. Why? Because if anybody sues you, doesn't matter, they cannot confiscate your house, even if they have a judgment. So they have the best property laws. So if you do want to look at something from that perspective, I would look in Florida or Texas. No place else. And Florida's probably better because you have a very high population of retired people. And so you also, at that point, have a natural tendency to restrict maybe excessive taxes because they realize these people are retired and not working. So that helps a little bit with Florida, and they don't have an income tax. So, but property in general, I would say, well, where it's collapsing is interesting is in Paris. You can rent a mansion, and I mean a real mansion, for hardly anything. Why? Because they're raising the taxes on the rich to 72%. The French just picked up and left. You know, tons of them are in, I stopped in some restaurants in London a few weeks ago, and I thought I was in Paris. Everybody was speaking French. They moved to London, and so their houses are up for rent. Nobody will buy because nobody wants to move there. And that's what, you know, the French government did. They said, oh, we'll make the rich pay. They can leave. You know, that's the other side of it. You have Canada, Australia, United States, and Britain property rising because a lot of capital is coming in. And between, you know, that helps to push the prices a bit higher. But so just keep in mind the Chinese tend to look at the high ticket items. The others are buying, you know, properties to live in or to make income from.
And of course, in Vancouver, you have geography. We have the ocean on one side, the U.S. border, and mountains, and a valley that ends up being a bunch of mountains as well. So there really isn't a lot of land here to buy, and yet with the climate here, it's mild in the winter. We don't have blistering hot summers. I mean, just in terms of scenery and climate, it's a very nice place to live.
Yeah, no, Vancouver, you know, looks very nice. It always reminded me of Geneva a little bit with the mountains and the snow caps that you can see right there. Plus, you have the jet stream, which then turns down. And we joke that, you know, ever since, you know, NAFTA, you know, you Canadians have been sending us a lot of cold weather. But that turns down after Vancouver. So you do stay, you know, kind of nice and snug up there.
We literally do have palm trees on our beaches. We do.
It is very, very nice. I wouldn't live in Chicago for, I don't care how much money you give me. But, and I mean, this last winter, it got pretty cold over here in Jersey. Pretty bad. So, Florida's looking better even for me, quite honestly.
August 14th, the London Silver Fix is going to change. It's something that's been there for, I think, over 100 years, simply because they have found the fix really is fixed. It's been manipulated to death, and they're going to have, instead it'll be called the London Silver Price. Is there going to be any difference? Will it still be a good way to set the price of silver, or again, will it just be manipulated like we hear about everything else?
I think the manipulations are starting to decline a bit, but that's what I was talking about when Rubin, you know, left Goldman Sachs and became the head of the Treasury. And that really opened up, you know, the floodgates, and then the banks started taking over the commodity industry. And in the 70s, there were always manipulations to some degree. I mean, when they wanted wheat prices to go up, they would just move the wheat out of the silos, put it in tractor trailers, drive it around town, and then when the inventory was done, everybody go, oh my God, we were 20% short on wheat, and just bring it back in. They played games on the silver fix and gold fix for years. You just move the inventory from New York to London, make it appear as if there's a shortage, and they jack the prices up, and as soon as they get it up to wherever they wanted to, they would basically sell it. But they were largely bear markets, And the platinum market was the same thing. They bribed Russian officials to take all the platinum back, take an inventory. Platinum rose dramatically in prices, and then as soon as it reaches the level that they want, they basically go short, sell it to all the, everybody that needed it, like Ford Motor Company, etc. And then miraculously, the Russians say, "Oh, okay, fine. We took the inventory, and by the way, we found 20% more." So, this stuff's been going on for a long time. You can't manipulate from the standpoint of turning a bear market into a bull market or vice versa. But you can increase the volatility within the trend, and that's been going on for a long time. The silver fix was never really that dramatically manipulated per se. Maybe a few pennies one way or the other, years ago. But once you moved in the 90s into really aggressive banks owning this stuff, that's when everything got really bad. And it started when, after the first gold boom in 1980, the big commodity trading house was called Phillips Brothers, or Fibro, out of Connecticut. They bought Salomon Brothers. Salomon Brothers was the biggest bond house on Wall Street. Within less than 10 years, they get caught manipulating the U.S. government treasury auctions. And that's when Warren Buffett steps in. "Okay, don't shut them down. I'll take it over," and all this other kind of stuff. Then it's sold and becomes Smith Barney, Solomon Smith Barney at that point. But that was the introduction. They brought the commodity way of manipulating markets into Wall Street. Now they're going after the banks for everything under the sun, and we're driving them out of the proprietary trading to some degree, which I think should have been illegal, period. But that's the name of the game. And so, I think it's probably going to take another 10 years to really get them out, and after the next real crash, it should help. But effectively, the banks were becoming nothing more than hedge funds trading money, but the problem was that they kept all the profits and they handed you only the losses.
Where can people find out more about where you've come up with so many of these ideas and how they could use your thoughts on this to maybe profit for themselves?
You can go to our website. It's armstrongeconomics.com, and we have a whole host of things on there that's largely for free for everybody to understand. And you can research a lot of subjects, debts, and tremendous amount of material we put on our site for free.
After the break, Ross Clark on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Ross Clark from CIBC Wood Gundy. Today we'll be taking a look at charts connected to what happened in the markets and with the Canadian dollar. In fact, we'll be looking at the Canadian dollar, the S&P index, and gold. Let's start off with the loonie. What's happening there, Ross?
Well, a tough week for the Canadian dollar. Finished off the week about 92.5. And this has been an interesting year, pretty much, for the Canadian dollar. And we started the first part of it with everybody slowly turning bearish the tail end of last year and pushing into January, February, to the point where sentiment had just got to an absolute extreme, and you ended up with commitment of traders numbers, this being the numbers from the U.S. that tell us the futures contracts positions that are held by large and small speculators, that are held by commercials in terms of doing hedging, and those numbers had reached major extremes into the February period. So it would only be natural at that point that we would see a corrective rally. And that's really what we've had. We've come from 88.5 all the way back to 94. And our view here is that this rally is just it's a classic rally within a bear market. And it's not that, the dollar, we think the dollar has still got further to go on the downside. But the corrective rally to the upside is pretty much needed when you've got excesses in terms of positions. When the bulk of the investors have placed their money, made their bets, and you get a lack of news that is supportive to that trend, and it starts to work its way back, they pretty much feed on themselves in terms of looking for an exit door. And that's what we saw as we moved through June and early July. The dollar pretty quickly, when it broke out through the 92 level, rallied up to 94 and got into what we consider to be some nice overbought levels. So at this point, we've got economic data in Canada and the U.S. due out next week, probably going to show more GDP numbers that are soft and probably softer in Canada than in the U.S. We've got employment numbers at the end of the week, something to keep an eye on there. But I think that, when we look at the dollar, the numbers probably are going to come in on the soft side, and realistically, targets that we would have would be below the lows that we saw earlier this year.
How's our dollar? I know we always compare ourselves to the American dollar, but compared to, say, Asian currencies, the euro, the pound? Well,
in terms of the movement, we really have been weak on a very short-term basis here, because if we look at something like the euro, it has been under significant pressure for pretty much I would say the last calendar quarter here, whereas the Canadian was holding up reasonably well. In this last week and a half, as things have really come under some pressure, it's been more, I would say, a strength in the U.S. dollar against everything. We've had the euro drop a good 2 or 3 points in the last 2.5 weeks. That's proportionately the same type of thing we're seeing in the Canadian dollar. So I think the easy move is to, as we always say, don't fight the Fed. In this case, it's don't fight the Bank of Canada. They would love to see some weakness here to help out the mid-Canada in terms of Ontario and the need there to produce product that can be sold competitively. It's a matter of getting this dollar down and trying to help out the major manufacturers.
We'll have more with Ross Clark next on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're chatting with Ross Clark from CIBC Wood Gundy. What's happening with the Standard & Poor 500 index?
Well, market's been on a roll for weeks and weeks, or I should say months and months. But this week we came off soft at the end. We're in the middle of earnings season, so we're getting some stocks that are blowing out the lights on the upside. Others, in particular, over into the retail side that are not doing terribly well. So markets took a break here at the end of the week, and when we look at I like to look at seasonals, and we look at the seasonal pattern. The years in which you are the midterm election cycle for the U.S. and when we look at the decennial pattern, how you move through a decade. Typically, this year, the fourth year in the decade and the midterm election year, we would tend to see a fairly choppy action as we move through the summer into an October window, and from there we'd expect to see pretty good strength into the spring. So in terms of the choppiness right now, this is in the last couple of weeks, we've seen that the number of stocks participating on the upside has really started to wane off at this point, so that you've got the NYSE, the New York Stock Exchange Advanced Decline Line, has shown its first inability to move to a new high with the Dow and the S&P indices in this last couple of weeks. And we haven't seen that since last summer, and at that point it was enough to give the market a correction in that 8 to 10% range. So looking at it from where we are right now, that would be reasonable from a technical perspective. Also looking at the length of time that it's been since we had a deep correction. And when we look at the lead that might come from the bond market, there's been a shift away from the high-yielding risk products towards the higher grade items, both on the corporate and on the government side. And so that you've got, U.S. 10-year yields right now back down to the 247 level. So money's been moving more and more towards the safer end of things. And, you're seeing that across in the equity markets, as I say, with not as many stocks making new highs. You've got the Russell 2000, the broad index there, failing to make a new high on this last rally in July. So it's the choppy period with maybe a bit of downside bias for the next little while would appear to be something that's in the cards.
Let's look at something bright and shiny. Let's take a look at what's happening with gold.
Well, this was in our work deemed to be the year in which the precious metals would create a base. It's 2.5 to 3 years now since the gold and silver markets topped. And when you've had a euphoric move like we did into $50 silver and $1,900 gold back then, you can have different types of corrections. And the one that we've gone through in this last 2.5 years is a very, very similar match to what we saw in the Dow following the 1929 top, the Nikkei in 1989, NASDAQ in 2000. And so when we look for the patterns there, particularly there's some things that will stand out. You'll end up with the supports being, in this case, about in terms of the mining indices, about 70% off the high, which is what we saw this time. You'll have an original low that you put in, which we had last June of last year, a good bounce, a retest of the support area, and then just a thrashing around. And we've seen this period here from the May low on has been really interesting because the miners have been leading us off the bottom, which is just the opposite of what we were seeing a few years ago at the top. The miners were incapable of participating. So with these positive trend score improvements that we're seeing in the miners, that's a good positive. Now, on a shorter term basis, as we got into the end of May, at the end of June, early July, commitment of traders numbers were just going off the screen in terms of the big levels of participation that we were seeing. In a span of 2 weeks, the number of contracts expanded by over 100,000 on the speculative longs, combined with the commercial shorts. And we've only seen that 3 or 4 times in history. And every single time you ended up with a 4 to 6% price break. Even in the basing or bull markets, you would see that type of a break. And what really fits in well is that from that level that we had a few weeks ago, this week's break into the 1290 range on gold just matches the 4% right on the nose. So I'm happy to see that. The other thing that you would want to see as part of the base building and in the latter part of it is that your 200-day and your 150-day moving averages would start to become support under the market, and you'd see the averages cross so that the shorter-term moving average would cross over the longer term. And we saw both the moving averages cross this week and prices get down and test them just perfectly. So in terms of the patterns that we look at, as long as we can hold the 1266 to 1290 range that was the support this week, the probabilities of a breakout are looking just exceptionally good. From a technical perspective, the number that I'm looking at this point is 1325 on gold. If we can close through there, I believe that will be a catalyst that will allow prices to break out to new highs for the year. And the main target on the upside is in the 1430 to 1470 range.
Ross, is there a website people can go to check out some of these numbers?
Well, what I would suggest, I have a PDF with the details in it, and if individuals would care to contact me, they can do that by sending an email to rossclark@shaw.ca.
Thanks to our guests, Ross Clark and Martin Armstrong. And thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.